James Rickards, The Death of Money, The Coming Collapse of the International Monetary System. In The Death of Money, The Coming Collapse of the International Monetary System, author James Rickards reveals how modern currencies have shifted from possessing intrinsic value to relying on government-backed fiat money. The book delves into the challenges faced by the global economy, such as financial warfare, and how countries like China, the US, and the Eurozone have contributed to looming crises threatening the world's monetary system. Rickards also explores the growing distrust in traditional currencies, the potential benefits of reintroducing the gold standard, and how individuals can safeguard themselves in an unstable financial landscape.
The rise of fiat money. In today's economy, fiat money is the norm, paper money or coins that lack intrinsic value but are accepted as a means of payment because of government backing. Prior to 1972, the global economy was based on the gold standard, where the value of currencies was linked to the price of gold. However, after the financial crisis of 1973, governments lost their confidence in the ability of the US to maintain the fixed rate between dollars and gold, leading to the creation of fiat money. Today, the global economy based on floating currencies is facing new challenges. The power of financial warfare. The aftermath of the 9/11 attacks highlighted the potential of financial warfare as a strategy used by criminals and states to attack their enemies or profit. Financial warfare can be either offensive or defensive in nature. An example of offensive financial warfare occurred in 2012 when the US excluded Iran from the global payment system, causing the Iranian currency to depreciate. Iran defended itself by buying up gold in bulk. The financial crisis of 2008 also demonstrated the potential seriousness of financial warfare, and as a result, the US and China have now developed procedures for financial warfare alongside their traditional military forces. The global economic system is fragile and vulnerable to such attacks, with even small terrorist or criminal groups having the potential to cause significant damage on society. Looming financial crises. Despite the passage of 5 years since the global financial crisis, the world economic condition still faces potential challenges. This book's summary highlights two possible crises that could threaten the global economy. The first is the housing bubble in China, where investment has been misplaced due to corruption plaguing the government. The second crisis is brewing within the US, involving the formation of a student loan bubble. As politicians continue to encourage students to take on more loans to boost consumption, the inability of graduates to find jobs means that a massive loan default could happen in the near future, triggering another global financial meltdown. Knowing about these two crises can help readers make more informed financial decisions. The fragility of the world reserve currency. Are we ready to say goodbye to the US dollar as the world's reserve currency? The global financial system is built on trust in its reliability, but recent developments, including the dissatisfaction of the BRICS countries, OPEC states, and the strengthening euro, have threatened its stability. The US presidency's domestic fiscal policy could also adversely affect the dollar's status. Perhaps it's time to consider a new global currency system. The national debt dilemma. The US national debt has grown larger than the economy, and politicians have two solutions: strengthen the economy or encourage inflation. While strengthening the economy is the sensible way to tackle the issue, it is not always easy to implement. On the other hand, inflation is the more popular but problematic solution. Quantitative easing, which involves printing more money, increases inflation by giving people more money to spend, driving up prices. However, this method has not been effective in reducing the national debt. Deflationary pressures from cheaper labor and energy costs in developing countries disrupt its effectiveness. The currency conundrum. The US government hopes to address its debt by printing more money. However, this approach erodes the people's confidence in the dollar. Though printing more money may appear to stimulate growth in the short term, it doesn't expand the economy in reality, making this a money illusion. It decreases the currency's value over time and erodes the savings of individuals and investors, resulting in a decrease in their confidence in the dollar. Consequently, this loss of faith applies to the dollar-based global monetary system, which can be seen in the trend towards various payment options, including digital currency like Bitcoin and electronic bartering. Bitcoin, in particular, has gained popularity and currently has over $7 billion in circulation, indicating that people are searching for alternatives to cash. Additionally, electronic bartering enables transactions without the need for cash as a mediator. While it's unsure if the currency alternatives to cash are viable in the long term, they provide alternatives worth exploring for the time being. Shifting from the dollar. The current global financial system backed by the dollar is in trouble, and the IMF Special Drawing Rights, SDR, is a potential solution. Although not officially a currency, the SDR holds a stable value derived from major currencies and could replace the dollar as the global reserve currency. This shift would bring the benefit of an international entity, the IMF, determining monetary policy based on the world's interest rather than just the U.S. national interest. This move is supported by the world, including the U.S., as a weak monetary system is not in anyone's interest. Gold as an anchor. The global monetary system has moved away from gold, but it may be time to consider bringing it back as an anchor for currency value. The current system is disconnected from solid backing and relies on Ivy League graduates to determine policy. The gold standard would provide a stable reference point for value, but it requires careful planning and consideration. One challenge would be determining a new price for gold that can cover the worth of the world's money supply. At a current price of $1,500 per ounce, all the gold in the world would not be enough to back up the worth of $2.5 trillion in the global money supply. However, if the gold standard were to be reintroduced and paired with proper planning, gold could be the savior of the global monetary system. Protecting your wealth in times of inflation. Inflation and hyperinflation can render money worthless and lead to social disorder. To safeguard wealth, it's crucial to have a diverse investment portfolio. The portfolio should comprise of 20% gold bars, 20% property in locations experiencing an influx of people, 20% alternative financial instruments such as hedge funds, 10% fine art, and 30% cash. Cash is the most flexible instrument to hold, allowing allocation to the most prudent investment during a crisis. A well-rounded portfolio will ensure survival and prosperity in the face of hyperinflation and social unrest.
James Rickards' The Death of Money exposes the fragility of the global economy and the significance of the shift from gold-backed currencies to government-backed fiat money. It explores various challenges, such as financial warfare, crises in China and the US, and the diminishing confidence in traditional currencies. Alternative payment methods, like electronic cash and the IMF special drawing rights, offer potential solutions, but Rickards argues that reintroducing the gold standard can provide a crucial anchor for a stable monetary system. To cope with possible economic changes, having a diverse investment portfolio across various assets, including gold, property, and art, is essential for wealth protection and future resilience.